Hello students, how are you? Let us begin financial planning. In first part, we covered financial decisions like investment decision, financing decision, and dividend decision. We also covered objectives of financial management, and we also discussed about various factors affecting different types of financial decisions. Now in this part 2, we will learn financial planning and other aspects of financial management. Now, today's topic is financial planning. What is financial planning? So, financial planning is nothing but it is an estimation of fund requirement of a business and specifying the sources of fund. So when you decide in advance what amount of fund would be required in future for your projects and you plan out different sources from where fund would be collected, that is known as financial planning. Objective of financial planning is nothing but just to ensure that enough funds are available at right time and there should not be any surplus fund. Financial planning involves various aspects. Say for example, first point, estimation of quantum of finance. That means here we plan out in advance what amount, what quantity of fund would be required. Second, determining the pattern of financing. That means we decide in advance proportion of various securities to be issued. We will decide how many equity shares will be issued, what amount of fund would be collected by way of debenture, what amount of fund would be raised by way of bank loan, and so on. It also covers proper utilization of finance. So financial planning is nothing but just when we involve the process of planning for finance, it is called financial planning. Now, what are the different types of financial planning? So financial planning includes two types of planning. One is long-term financial planning and second is short-term financial planning. Long-term financial planning focuses on capital expenditure for long-term growth and investment in business, say for 3 to 5 years. Short-term financial planning, it is in the form of budget and it is normally for 1 year or less than 1 year. So there are two types of financial planning, long-term and short-term. When the period is more than 1 year, we can say it is a long-term financial planning. But if it is a period is only 1 year or less than 1 year, we can say it is a short-term financial planning. What are the objectives of financial planning? So as I said earlier, it has the objective to ensure that availability of fund whenever required. That means funds should be available when we require. It includes estimation of fund for long-term and short-term needs of the organization. Second, to ensure that firm does not raise resources unnecessarily. There should not be idle fund. It will help to minimize the loss due to idle fund in the organization. So it has main two objectives that you can see. To ensure fund is available whenever we require, and second, there should not be idle fund. We should not raise unnecessary fund because we are borrowing from somewhere. So ultimately we have to pay cost. Say for example, if you borrow money, you have to pay interest. So if you unnecessarily borrow more fund, then your cost of fund will increase. So in financial planning, we take care of enough fund is available on right time and there should not be any idle fund. So from our discussion, we can say some important points of financial planning. The first point of importance is forecasting. Financial planning helps the organization to foresee the future financial requirement in advance, because here we plan in advance about financial requirement in future. Second, it avoids uncertainties and helps in meeting unexpected situations by arranging necessary funds, because here we plan out in advance that what would be the requirement in future. Third, coordination. It helps to coordinate the activities of all the departments in the organization by allocating them necessary fund in time. So proper coordination is possible if proper financial planning is done. It reduces wastages because we plan in such a way that enough fund is available and there is no idle fund. So through proper planning about the financial requirements helps to reduce wastage and duplication of efforts. We plan out in such a way that in one issue of equity shares only we collect enough fund. Or when we borrow from bank, we make proper planning so that enough amount only is borrowed and not more amount is borrowed. Easy evaluation. It helps to evaluate the actual performance of the organization based on the plans formulated in advance. So these are the 5 points of importance of financial planning. Our next topic is capital structure. Our first topic was finance function. In that we took 3 decisions. Our second topic was financial planning. This is our third topic, capital structure. Now what is capital structure? So we know company can raise fund from various sources of fund. Say for example from equity shares, preference shares, debentures, long-term loans and reserves and surplus. So when we decide mixture or we can decide composition of all these sources of fund, then it is known as capital structure. So capital structure is nothing but deciding from where or from which sources fund would be collected. In this, we decide proportion of different sources of fund. So you can see the meaning. Capital structure refers to mix or composition of long-term sources of fund such as equity share capital, preference share capital, debentures, long-term loans and reserves and surplus. So it is a mixture of various sources of finance. In other words, it refers to the proportion of borrowed fund to owner's fund. It is a mix between owner's fund and borrowed fund. Company does not collect only from equity shares or preference share. Company has to decide different sources of finance because our ultimate aim is wealth maximization, profit maximization, and for that we have to reduce cost. So such a mixture of sources of finance should be decided where cost is less and more fund is collected. Owners fund are called equity and borrowed funds are debt. The capital structure of a company consists of any of the following. So this mixture may include following areas. Company may decide only equity shares, or it may decide the mixture of equity shares and preference shares, or it may decide equity share, preference share and debentures, or equity share, preference share, debentures and long-term loans. Now our next topic is financial leverage. What is financial leverage? Financial leverage is proportion of debt in the capital structure. It is also known as capital gearing and trading on equity. So what amount of debt fund is there in the total capital structure of a company is known as financial leverage. When the proportion of owner's fund in capital structure is very small, it is said to be highly geared company. Whereas if borrowed fund is small, then equities, it is called a low geared company. As the financial leverage increases, that means highly geared company, the cost of fund declines and therefore more earning per share, but the financial risk increases. That means in case of highly geared company, the proportion of debt finance would be more. So we have to pay interest, and that's why financial risk increases. Now what is financial risk? So inability of a company to make fixed payment like interest on debenture, interest on bank loan is known as financial risk. So when we talk about highly geared company, then they are collecting more fund by way of debt. So financial risk would be high. Let us understand this with the help of example. On screen, you can see three companies are given. Company A, Company B, and Company C. Let us understand impact of financial leverage on profitability. Now, when financial leverage means debt in capital structure. So depending upon the debt in the capital structure, it will affect earning per share of a company. So here three situations are given. You can see number of equity shares issued by company A is 30,000, B 20,000, and C 10,000. So their equity share capital is 3 lakh, 2 lakh, and 1 lakh because face value of equity share is rupees 10. So 30,000 into 10 is equal to 3 lakh, 20,000 into 10, 2 lakh, and 10,000 into 10, 1 lakh. So this is their equity share capital in all the three companies. Now, suppose company has also collected fund by way of issuing debenture, that is debt financing. Company A has not issued any debenture. Company B has collected rupees 1 lakh by 10% debenture, and company C has collected 2 lakh by way of debenture. So what would be their total capital? In company A, 3 lakh totally from owner's fund, that means equity share capital. Company B, total capital is 3 lakh, but in that 1 lakh is debt financing and 2 lakh is from owner's fund, equity share. Company C, you can see only 1 lakh rupees from equity shares and 2 lakh rupees from debt financing. So here you can see company C has maximum amount of debt, rupees 2 lakh, whereas company A has not collected any fund by way of debt, that is debenture. Now, let us see its effect on earning per share. That means we are now understanding financial leverage on profitability. Suppose profit is 20% on investment. So their capital investment is 3 lakh, 3 lakh, 3 lakh. So 20% of 3 lakh is 60,000, 60,000, 60,000. So this is profit. Now if we talk about interest, so company A has to pay nothing because it has not issued any debenture. So its interest on debenture would be nil. But company B has issued 1 lakh rupees debenture. It has collected fund of rupees 1 lakh by way of debenture. And the rate of interest is 10%. So 10% of 1 lakh is 10,000. So it has to pay interest on debenture 10,000. Company C has issued 2 lakh rupees debenture. It has collected 2 lakh rupees by way of debenture. So 10% of 2 lakh is 20,000 interest on debenture. So now what would be their net profit after subtracting interest? Because interest is one type of expense that we minus. So in case of company A, interest is nil, so its net profit is 60,000. In case of B, it would be 50 because 60,000 minus 10,000 interest, so 50,000 would be the net profit. And in case of company C, 60,000 minus 20,000, so 40,000 would be the net profit. So this is the net profit. You can see company A has highest net profit, company C has lowest net profit. But what will be the effect of financial leverage? Earning per share. Now, if you want to find earning per share, then what you have to do? You have to divide net profit by number of equity shares. So let us talk about company A. Company A net profit is 60,000. divided by number of equity shares 30,000. So 60,000 divided by 30,000. So earning per share will come rupees 2 per share. That means per shareholder rupees 2 earning is there. Now if we talk about company B, who has also issued debenture of rupees 1 lakh. So here you can see net profit is 50,000 and number of equity shares are only 20,000. So 50,000 divided by 20,000. So answer will come 2.5. That is earning per share is 2.5. In case of company C, net profit is 40,000 and number of equity shares are only 10,000. So 40,000 divided by 10,000. So it will come rupees 4. Now compare all these three. Which company's earning per share, that means earning to equity shareholder, is higher? Definitely it is for company C. So we can say when we issue debenture along with equity share, then earning per share can be increased. But there is one condition. This is possible only when rate of return on investment is higher than rate of interest. Otherwise, it is not possible. If the rate of interest is high, then the rate of return on investment, then this is not possible. So this condition you should be keep in mind. What condition? Return on investment should be high, then interest on debenture. Here, investment is getting 20% return, whereas rate of interest is 10%. So 20% is greater than 10%. And that's why when company issue more and more amount of debt, then it is getting higher earning per share. So we can say when rate of return on investment is higher than rate of interest on debenture, in that case, if you issue more amount of debenture, you collect more amount by of debt along with equity share, then you will get the benefit of trading on equity. Yes, I use the word trading on equity. Okay. Financial leverage. Now what is the leverage? Company C is high, company B low, and company A unlevered because it has not issued any debenture. So I think you must have understood what is financial leverage. Financial leverage means proportion of debt in the total capital. So here company C has more amount of debt compared to owner's fund, and here company C is getting high earning per share because rate of return on investment is higher than rate of interest on debenture. So now let us discuss in detail what is trading on equity. Already I discussed financial leverage is nothing but trading on equity. It refers to the use of fixed income securities such as debenture and preference capital in the capital structure so as to increase the return on equity capital. So trading equity means use of fixed income security. Debenture is a fixed income security because on debenture fixed rate of interest is given. Preference share capital is also fixed income security because the rate of dividend on preference share is also fixed. So when you use fixed income securities in the capital structure to increase return on equity capital, then it is known as trading on equity. That you can see in our previous slide. Company C has used debt. Company B has also used debt with their equity capital, and their earning per share is definitely higher than company A. Company A has not used any debt and its earning per share is only rupees 2. But when you use debenture along with equity share, then definitely your earning per share will increase. But the condition is rate of return on investment should be higher than rate of interest on debt. So that is trading on equity. In other words, equity shareholders get additional profit with the help of employing other fund. It is also known as financial leverage or capital gearing. One more example is given for your understanding. See, A company raises rupees 50,000 through equity shares and earns rupees 5,000 profit. Here the rate of return is 10%, because on 50,000, 5,000 rupees profit is available, so it is 10%. On the other hand, if company raises rupees 40,000 by way of 6% debenture and 10,000 through equity share, so total is 50, 40 and 10,000, 50. The rate of return on equity shareholder is increased to 26%. How? See the calculation. Total investment 40,000 plus 10,000, 50,000. 40,000 is debenture and 10,000 is equity shares. Total profit is 5,000. Now on this 40,000 we have to pay interest at 6% because there are 6% debentures. So 6% of 40,000 is 2,400. So what will be the balance profit? So balance profit to equity shareholder. From total profit 5,000, 2,400 is given interest. So remaining is 2,600. Now what is the share capital? That is only 10,000. So return on equity share capital is equal to 2,600, which is totally available to equity shareholder now, divided by 10,000 into 100. So we are getting 26%. So meaning to say, when company issue only equity share, it is getting only 10% return. But when along with equity share, when company issue debt, debenture, then it is getting higher return, that is 26%. So this game is known as trading on equity. I said it is a game. Mostly intelligent financial manager do this game. They do not issue more number of owners fund. They collect money by way of fixed income securities. And after paying fixed interest and fixed dividend to these fixed income securities, remaining profit is available to the owners, and definitely they are getting high return. Okay, so that is trading on equity. So you must have understood what is trading on equity. Now our topic is, which are the factors affecting choice of capital structure? We all know capital structure means deciding proportion, mixture of various sources of finance. So here we are discussing which factors should be kept in mind while deciding capital structure. So the first point, cash flow ability for serving the debt. See, when you collect fund by way of debt, then you have to pay interest. So you must have required amount of cash. So cash flow ability for serving the debt must be there. Servicing debt means paying interest and principal amount of loans as and when it is due for payment. If a debt is to be included in the capital structure, the company should estimate the future cash flow to ensure the coverage. If company is sure that in future required amount of cash would be available for servicing the debt, then it should go for debt. So while deciding debt financing, enough amount of cash flow should be available. This is first point. Second point, interest coverage ratio. Interest coverage ratio refers to the number of times, how many number of times, earning before interest and tax, that is known as earning before interest and tax, EBIT. Some people are saying PBIT, profit before interest and tax, covers the interest obligation. Higher the ratio means lower the risk for the company to pay off interest in time. I am giving you one example. Suppose our EBIT is 50,000. That means earning before interest and tax is 50,000. And suppose we have to pay fixed interest 10,000. So EBIT divided by interest. That means 50,000 divided by 10,000. So answer will come 5 times. That means company is able to pay 5 times interest because its EBIT is 50,000 and interest payment is only 10,000. Other case, suppose EBIT is 1 lakh rupees and interest is 10,000. So 1 lakh rupees is EBIT divided by interest 10,000. So answer will come 10 times. So if these two cases are given, then we can say a company having 10 times interest coverage ratio is better than 5 times. No doubt, both are better because both have high interest coverage ratio. So, if you are deciding to collect fund by way of debt, you should also keep in mind your interest coverage ratio. It should be sufficiently higher. Next is debt service coverage ratio. The cash profit generated from the operations must be enough to service the debt and preference share capital. So this debt service coverage ratio includes not only the debenture, but it also includes preference share capital. So debt service coverage ratio takes care of the deficiencies referred to the interest coverage ratio. In the interest coverage ratio, we considered only the debentures. But in the debt service coverage ratio, we are covering not only the debentures, but also preference share capital. The cash profit generated by the operations are compared with the total cash required for the service of the debt and the preference share capital. Here the formula is not written, but I am saying you what is the debt service coverage ratio. How will you find? So for that, you have to take profit after tax. In that you will add depreciation plus interest plus non-cash expense. Again, profit after tax plus depreciation plus interest plus non-cash expense, and all this will be divided by preference dividend plus interest plus repayment obligation. So you will get debt service coverage ratio. A higher debt service coverage ratio indicates better ability to meet cash commitments and consequently the company's potential to increase debt component in its capital structure. So in interest coverage ratio, we have just taken debt, but in debt service coverage ratio, we are taking preference capital also. Next one, return on investment. If return on investment is higher, then the rate of interest for debt borrowed fund can be increased in capital structure. Otherwise, increase in equity portion is good. In my previous slide, I have discussed that if you want to get the benefit of trading on equity, then your return on investment should be higher than interest for debt. Then you can get the benefit of financial leverage, capital gearing, or we can say trading on equity. So these are the different factors which should be kept in mind before deciding proper capital structure. Next, fifth number, cost of debt. Cost of debt means the interest which we have to pay to the debenture holder. If the firm is able to borrow at lower rate, it may prefer more debt than equity in capital structure because debt is cheaper. But if the rate of interest is high, firm should not go for debenture. Next one is tax rate. Income tax liability can be reduced by employing borrowed fund in the capital structure, as interest on debt is a deductible expense. So when you collect fund by way of debenture, then you have to pay less amount of tax because the interest paid on debt is deductible expense. It will reduce your tax burden. So if you are thinking about reducing the tax burden, then definitely you should go for debt financing. Next one is cost of equity. Equity shareholders also ask return. They ask for dividend. So the amount of dividend paid to equity shareholder is cost of equity. So when a company increases debt in their capital structure, the financial risk faced by the equity shareholder may increase because equity shareholder are ultimately the owners. And as I told you earlier, financial risk is inability of company to pay its fixed charges like interest on debenture. So when more amount of debt is collected, financial risk will increase so that the company cannot use debt beyond a point. So we should also keep in mind cost of equity, flotation cost. As we discussed earlier, when we collect fund from different sources, then we have to pay some expenses of collection of fund, As I told earlier, when you are planning for public issue, then you have to make advertisement, you have to uh, do some printing work, you have to print prospectus, and all these expenses are flotation costs. So as far as possible, we should select such a capital structure, we should select such a source of fund in which flotation cost is less. So it is the cost incurred for floating, that means issuing securities such as brokerage paid, underwriting commission paid, etc. It is generally less in case of debt. Next is risk consideration. A business has two types of risk. One is financial risk and one is business risk. See, the meaning of financial risk is given: to pay interest, preference dividend, repayment of debt. All these are the financial risks. And business risk means operating risk. It must be considered while choosing suitable capital structure. So many other points are discussed: flexibility, control, regulatory framework, stock market conditions, capital structure of other companies. So all these points you can go through. Slide is here. You can read it. They are very simple. And if you find any difficulty, you can put your comment. I will answer. Okay.